Hello and welcome to the Equity Expert Podcast. I'm Jen Namazi. I'm the Director of Content for the NASPP. And today I'm joined by our Executive Director, Barbara Baksa. She is going to help join me in what is the second of a series of episodes we are covering, focusing on some of the data, the trends, and observations that have emerged from our NASPP and Deloitte Consulting 2020 Domestic Stock Plan Administration Survey. Before we get started, I want to just remind our audience that this episode is part of our entire Equity Expert podcast series. The series features discussions with a variety of professionals in the field of equity compensation around some of the practices, trends, and other career-related topics. You can find the podcast in its entirety on our website, naspp.com. It's also available on the podcast apps on your mobile devices like iTunes, Stitcher, and Spotify. So moving on to our topic of the day, I want to just take a moment to give some context for some of the data that we're discussing because it is coming from a very substantial survey, and that is the 2020 Domestic Stock Plan Administration Survey. This is a survey that is developed jointly by National Association of Stock Plan Professionals, NASPP, and Deloitte Consulting, and provides a very detailed look at the administrative practices of companies primarily headquartered in the United States. The topics covered in this survey include stock administration and communication practices. We touch on staffing, organizational placement, telework, ESPPs, insider trading, and stock ownership guidelines. So this episode in particular, we're going to focus on the survey highlights related to employee stock purchase plans. If you are interested in the other aspects of the survey, you can find discussion on those in the other episodes within this podcast series. The first episode that we did on the survey, it covered telework, staffing, and education practices. We have other episodes planned that will cover insider trading and stock ownership guidelines, so be sure to check in on those. And then with that, we will get started with Barb. Thank you for joining us today.
Thanks. Glad to be here.
So I know we love talking about survey data because it gives us such an insight into, what's actually going on. What are the practices within organizations? And particularly around ESPP, I feel like we get a lot of questions around what companies are doing, what plan design features are being used or not used. And so I think we'll just start at the beginning, which is really around the prevalence of ESPP plans and, how many companies are actually have or have implemented these plans. And maybe we could start there, Barb, and you could talk through us through some of that data.
Sure. It works out to be just over half of respondents to the survey have an ESPP. Now, I should sort of clarify that the only companies who take our surveys are companies who offer equity to their employees. So it's not necessarily half of all companies in the world, but half of companies in the US that offer equity compensation to their employees do so in the form of an ESPP. They also probably offer other types of equity vehicles, but half of them have an ESPP. Now, it is true that most publicly held companies in the United States offer equity to their employees, so it probably works out to be just about half of all US companies as well, maybe just a little bit under half. And that's been really actually very consistent for the past several cycles of the survey. We do this survey every 3 years, and really going back to 2014, going back to 2017, then 2014, then 2011, like in all of those surveys, it's about half of companies that offer an ESPP. If we look all the way back to before ASC 718 was adopted in 2005, we did see, I think, a slightly higher prevalence of companies that offered an ESPP. But really we didn't really see a very significant drop. So it was maybe more around 60% before 2005, but really ESPPs are still very common.
And, it's good to have that reinforcement, and I feel like it has really been a long staple within companies, and I don't see it going away anytime soon. If anything, I know we get a lot of questions around ESPP, and there seems to be a growing interest from companies around these programs. So I would be excited to see how this trend continues to either stay stable or to even potentially grow a little bit.
Yeah, I'd love to see an uptick, and I'd love to say that we're for sure going to see an uptick. We do know that among the companies in the survey that don't currently have an ESPP, around 21% say that they are looking at implementing one. So it's possible we'll see an uptick, although I do think that 21% has been also fairly stable for the past several survey cycles. So I'm not sure that I would really count my eggs yet. But yeah, it would be nice to see a little bit of growth here. But 50% is still good, and the numbers are stable. We're certainly not seeing a decline.
Most definitely, and looks like it's here to stay. So we'll continue to regard that as a very strong component of offering equity compensation to employees. So with that said, we have two main types of employee stock purchase plans. We have a Section 423 qualified ESPP, which can, this qualifies for more favorable tax treatment under the IRS code when certain conditions are met. And then we have non-qualified employee stock purchase plans, which aren't subject to the or don't meet the requirements of Section 423 and therefore have little bit of a different tax structure. So with that, I know we do get asked that question, how many companies offer a qualified ESPP versus not? And so I know we have that data, and let's just touch on that for a little bit.
Yeah, what we see, and again, these numbers have been fairly stable for the past several survey cycles, is that around 80% of respondents to the survey offer a qualified ESPP. So really here in the US, they do really want to deliver that qualified tax treatment to their employees, and that type of ESPP is a very attractive plan, and it's by far the norm. I actually am a big fan of non-qualified plans. I think that you can really do some innovative things and deliver some fantastic benefits through a non-qualified plan. And I have in the past year or so been promoting that idea, but that really hasn't caught on. In the data, what we see is that hands down, qualified plan is the way most companies go.
And I wonder if part of that is because for some of these companies, they've had long-standing ESPP programs. Certainly not everybody, but sometimes I wonder if it's easier to just stick with what you know or what you have. But I know we have seen companies that have truly kind of taken an innovative approach and looked at when it's time to either implement a plan or revisit a plan design, and they have an opportunity to do so. We are seeing some innovative things coming out of that that may lead in a different direction. So definitely something to consider. So let's turn our attention to some of the features of qualified ESPPs, since that is the predominant plan in effect for most companies right now. And we have several different features within those plans. We have everything from discounts to lookbacks to the lengths of offering periods within those plans, and want to touch on all of those. But let's start with the 15% discount and look back, and then maybe you can also just touch on, since we mentioned non-qualified ESPPs, how that may vary for non-qualified plans as well.
Sure. So I would say that for companies that offer a qualified ESPP, most of them offer what is really a very generous plan. By far, the most common discount for companies to offer is a 15% discount. That's 70% of companies that have a qualified plan. And that's the maximum discount that you can offer under the tax code. They literally could not offer any greater discount to their employees unless they wanted to go to a non-qualified plan. And that's been, again, consistent. I would say the theme of all this data is consistency. Like, it really has not changed over the past several survey cycles. So we're certainly not seeing any sort of decline in the percentage of companies that are offering that level of discount to their employees. For non-qualified ESPPs, the data is a little more all over the place. First of all, just to preface this with because only 20% of companies that participate in the survey offer a non-qualified ESPP, we are looking at a much smaller sample size when we look at the non-qualified ESPP data, which means that this data is not necessarily as meaningful as the qualified plan data, and it can sometimes be a little bit dangerous to draw conclusions around trends from this data when you have a really small sample size. But what we see in the 2020 survey is that there's about, companies are about, there's about an equal percentage of companies that offer no discount and that offer a 15% discount. You've got 32% of the non-qualified plan companies offering no discount at all, And that is somewhat common among non-qualified ESPPs. Sometimes it's not really intended to be a great benefit for employees. It's just intended to be sort of a way for those employees who are interested in investing in the company to have sort of an easy way to do it. But we do see, just under that, 30% are offering a 15% discount, which is, although there's certainly no limit on the discount that you can offer in a non-qualified ESPP, that's the maximum discount you can offer with a qualified plan. So I think those 30% are maybe trying to align with the benefit that employees might receive if the plan were qualified. And then 23% offer a match instead of a discount. And that I really like the idea of a match. I think that's one of the real advantages to offering a non-qualified plan is the ability to do a match rather than having to deliver your economic benefit in the form of a discount. So it's interesting to me that only 23% take advantage of that opportunity. And it's certainly something I've been promoting. We'll see if I have any effect as in the next survey cycle.
Well, let's see how that goes. Hopefully you do, because I think there is a lot of flexibility with those non-qualified plans. So one of the other components of an employee stock purchase plan is the offering period, so which can be anything from, I mean, I have seen a month offering period. I think that's not very common, but all the way up to 24 months or even slightly beyond that. So can you touch on the length of the offering period and what we're seeing companies offer there?
Sure, absolutely. But before I do that, I want to first touch on whether or not the plans offer a look back, because really the length of your offering period really becomes important if you offer a look back. And a look back is when you calculate your price by looking at your fair market value on your purchase date, and then you look back to the fair market value at the start of the offering, and you take the lower of those two values and you apply your discount to the lower of those two values, so that if your stock price is appreciating over your offering period, employees could really realize in some cases, a very substantial discount. It could actually be much greater than the stated discount. So for example, if your stated discount is 15%, but if you have a look back and your stock price has appreciated over your offering period, your discounts could be significantly higher than 15% because employees are based on purchasing on 15% of that offering begin date fair market value. And what we see is that among qualified plans, 62%, so a majority of companies do offer a look back. That also has been consistent with the past several survey cycles. Look backs are significantly less common for non-qualified plans. In a non-qualified plan, only 35% offer a look back. So I think that's a real distinction between what companies do in a qualified versus a non-qualified plan. Now let's look at the length of the offering. Because the longer your offering period, the longer that look back is going to be, and so the greater opportunity there is for appreciation for the employee to realize. For Section 423 plans, which is really where we see, like I said, the most of the look backs, the most common offering period is 6 months, and that's about 50% of respondents. And then on top of that, we see another 25% that have a 3-month offering period. So really, 75% of respondents for non-qualified, 75% of companies that offer a qualified ESPP have either a 3-month or a 6-month offering period. That's by far the majority. We do see that 8% have a 24-month offering, which is really what's sort of touted as the Cadillac of ESPPs. A 24-month offering is no doubt a very generous plan, but it is definitely a minority of respondents that offer that plan. But even having said that, a 6-month offering and a 3-month offering with a 15% discount and a look back is still a really very generous plan. There's nothing, I can't think of a single investment right now where you're almost guaranteed a 15% return on your money over a 3-month or a 6-month time period. So those shorter offering periods, even though they maybe feel less generous when we compare them to the Cadillac ESPP, that's still a very generous plan and a really awesome benefit to deliver to your employees.
I definitely agree, and I think there's a number of considerations that go into a company's selection of what that offering period may be when they're in their plan design phase and considering things like accounting impacts and things like that. I feel like we have seen data or even correlation correlation information over the years that have suggested that higher participation rates of ESPP sometimes do correlate with some of these more lucrative features, right? Which is probably not surprising. If you had a Cadillac ESPP, you may, expect to potentially have an uptick in participation or not. But other things factor in, like the discounts we've talked about, whether or not there is the look back and so forth. So with that in mind, the next point we want to cover really has to do with the number of employees that are participating in their ESPPs and the data that we have around that. And so let's touch on that, and then I have some probably soapbox things I would love to stand on around that, but first we can get into the data.
Sure. And I think I'm going to be right there with you on your soapbox. I would say this is the one area of the survey that is always disappointing to me, is what companies report are their participation rates. For qualified ESPPs, 65% of companies, so that's almost 2/3 of the respondents to the survey, report that less than half of their employees participate in their ESPP. And we know, because I just went through this data, that those ESPPs are a great benefit, that in most cases they are very generous plans, and still less than half of their employees are participating in them. If we look at non-qualified ESPPs, which are not as generous, we've already seen that they are less likely to have a look back, and they are less likely to have a 15% discount. And that's reflected in their participation. So 88%, it's almost 90%. Like, we're nearing 100% of respondents reporting for non-qualified ESPPs, reporting that less than half of their employees participate in the plan. And so I would really like to see those numbers come up. And I guess the first takeaway is that if you've got more than 50% of your employees participating, you're doing pretty good. You're definitely in sort of the upper percentiles in terms of the participation rate that you're getting. And but I do see that, I do hear anecdotally companies in the Bay Area that have 80%, 90% of their employees participating in their ESPP. It is definitely possible to achieve high levels of participation, but I think a lot of companies just aren't there yet.
And I think, not to tout one plan design feature over another, but I do think, and I will put some of this in the show notes for people, because we have written about this in the NASPP blog, and we've covered it in some of our other resources in the past, just as this particular topic of participation comes up. But there is data that does suggest a positive correlation between things like the amount of the discount and the length of the look back and so forth, that really can help drive some of these participation rates up, where, as you mentioned, anecdotally or through case study examples, we've seen companies that had very low participation rates and were able to turn that around by just examining some of these features and really trying to figure out how they could leverage more of them to attract their employees to participate. And I think we've seen some very positive outcomes from those types of anecdotal and case study scenarios that our members have shared with us. So it is something to keep an eye on, and hopefully there will be a forward movement in participation rates, or upward movement, as more and more companies really try to figure out how to maximize the offerings to their employees, whatever works for them.
Yeah, I think there's really two components to having a great participation rate. And the first one is you need a plan that your employees want to participate in. And so if you have a plan that doesn't offer a discount or has only a 5% discount, you're not going to have a great participation rate. If you impose a holding period on employees where they're not able to sell their stock right away, that's absolutely going to impact your participation rate. If you don't let people withdraw from the plan, all of those restrictions are going to impact your participation rate. So the first step is having a plan that your employees want to participate in and that they feel comfortable participating in. One thing to remember with ESPPs is that this is not a plan that is targeted at your executives. This is targeted at rank and file employees, some of whom may be among your lowest paid. Some of them most certainly are among the lowest paid employees at your company. I have data it's from a couple of years ago, but it's from a careerbuilder.com survey that reports that somewhere near 80% of Americans report that they live paycheck to paycheck at least some of the time. And those are the people participating in your ESPP. So some of your employees are paycheck to paycheck, and this plan represents a risk to them. And if there are restrictions on how soon they can sell their stock, if there's not enough of a discount to mitigate that risk, they're not going to participate. And I can't even say that I would say that's a smart decision on their part to not participate. So the first step is having a plan that is generous enough that your employees are able to participate in it. And then the second step is that it is education. I mean, we already see from the data that we have here that many companies have plans that are generous. And we can see in our data that where companies are generous, where they have a 15% discount, where they have a look back, their participation rates are higher. So we see that. But the second step is, in addition to having a generous plan, you got to explain it to your employees. You got to get out there and promote it and really encourage employees to participate. And that's sort of beyond what we're going to talk about today, because we're really just focused on trends and the data. And that's a whole separate podcast in and of itself. But that is an important step to getting that participation that you want. And where companies have those sort of high levels of participation, 80, 90%, they're doing a lot of education around their plan. They're really invested in the plan.
Yeah, they really do go hand in hand, as you said. So I see we both have a lot of passion around this. So I suspect this won't be the last time we're talking about this. But let's move on for the sake of time today. So a couple more points we want to hit on in terms of trends or data that we have, and the next one is around fractional versus whole shares. So, what are companies doing in terms of allowing either fractional shares to be purchased, or do they round and allow only the purchase of whole shares? So let's talk about that for a moment.
So this is, I think, a relatively new practice. 20 years ago or 25 years ago, when I got into the industry, the idea of purchasing a fractional share was absurd. No one thought it was even possible. But it turns out it is possible. It's just an arrangement that you work out with your brokers, where the fractional shares get credited to employees' accounts, and they sit in those accounts. And then when the employees want to sell, the broker has a process you can't actually sell a fractional share, but the broker has a process to aggregate those fractions with other fractions that are being sold at the same time, or the fraction just gets cashed out. There are different ways to handle it, but it is possible to allow employees to purchase fractional shares. This is the first time we've asked about this practice in this survey, so I don't have any trend data. I can't really tell you how it compares to what's happened in the past. But what we saw this time is that 35% of companies allow employees to purchase fractional share amounts. And where I really see the fractional share purchases where I really see them as helpful is if your stock price is high. Like, another trend that we've seen lately is nobody wants to do a stock split anymore. Apparently, stock splits are just not something that cool companies do. And so you have companies whose stock is trading in the hundreds, or in some cases over $1,000 a share. And that high of a stock price makes participation in your ESPP challenging, particularly for your lower paid employees. They oftentimes are not able to contribute enough to be able to purchase even one share of stock. And so allowing those fractional share purchases allows them to use all of their contributions to purchase as much stock as possible. And that's where, in a plan for a company that has sort of a modest stock price, I'm not sure that being able to purchase a fractional share really is that much of a benefit. Usually the amount that employees don't, if they're only purchasing a whole share, the portion of their contributions that don't get used to purchase a share just roll over into the next purchase period, and they use it the next time. And that's fine if your stock's a modest amount, and that's a pretty modest amount of money that's rolling over every period from period. But if your stock's trading in the hundreds of or thousands of dollars, that's a lot of money to not get to use to purchase stock, and the stock price is possibly continuing to appreciate. So by the time you're able to use those contributions to purchase stock, the stock's worth even more money. And so in those cases, I think it can make a lot of sense for employees to be able to purchase fractional shares. And it'll definitely be interesting to see as we can, in the next survey, what happens with this trend, if we see that 35% increase, or if it's stable, or if it decreases.
Yeah, and this to me just highlights that there's a lot companies can do to really have some flexibility and really tailoring their plan design to what works best for their company. So I thought that was an excellent example where, a company that has a $500 stock price and, employees that, maybe are making minimum wage and they still want to offer that opportunity to participate, in an employee stock purchase plan, that gives them opportunity to contribute, within their means and still be able to have that tangible fraction of a share versus not even having enough to buy anything. So I
Yeah.
think from a morale standpoint and a participation standpoint, that would probably really draw in some employees who may not otherwise be interested or think that they may be excluded just based on the amount of money they're able to contribute. So touch on our last point now, and this one for me, I am excited to talk about this because I feel like it dispels a myth that I feel lingers around ESPP plans. And the myth that is that, well, if we offer this plan, the employees are just going to sell their shares anyway. I've heard people refer to it sometimes as like a forced savings plan where they're going to cash it out right away. And it's a lot of work to be able to administer, for that purpose. And so we want to touch on the data that we have around how long participants are holding the stock that they acquire under the employee stock purchase plan. And I think that data will lead us to dispelling some of that myth around just being a, quick turnaround savings program.
Yes, that is correct. And I'll just preface this by noting that the data that we have here is for qualified plans. What we're doing here is we're asking the respondent, who's the stock plan administrator at a company that offers an ESPP, we're asking that person to report to us what, or how long on average their participants hold their stock. And companies are only tracking sales if they have qualified ESPPs, so we don't ask this question for non-qualified ESPPs. We're just skeptical that the data would be meaningful. But for qualified ESPPs, companies are tracking their dispositions. They have to under the tax code. And so it's possible for them to tell us on average how long employees hold their stock. And what they tell us is 2/3 of them tell us that on average, their participants are holding their stock for 1 year or longer. So that's pretty significant. That means that certainly they're not seeing a whole lot of flipping of the stock. And it's true regardless of whether or not they have a holding period. Only 14% of respondents to the survey impose a mandatory holding period on participants. So I can include those 14% or I can exclude them, and it doesn't really change this data that much. So even without a holding period, almost 2/3 of companies see that participants hold on average for a year or longer. And this also, I've seen data on this from some of the brokerage firms where they can actually track, they actually have the data on participant sales, and so they're not looking to the stock plan administrator to tell them how long employees hold. They can actually see in their own records how long employees are holding the stock. And I would say that what the stock plan administrators tell us in our survey aligns with the data that I've seen from brokers. There is certainly going to be a small percentage of employees who are going to flip if you allow them to do that. I think that goes back to my careerbuilder.com data, where you've got 80% of Americans living paycheck to paycheck some of the time. For some of your employees, they're going to have to flip. There's not any other way for them to participate in the plan. But the majority of your employees are not going to flip. They're going to hold their stock in most cases. And I am not as concerned about flipping. You hear flipping as that word used really in a negative connotation, and that this is a horrible thing for employees to do. But if employees are continuing to participate in the ESPP, they're still invested in the company. They're continuing to buy stock. It's not like they've sold their stock and they're like, okay, well, I've made my money, I'm going to go retire. This is an ESPP. They're contributing 10% of their pay. No one's retiring in most cases off of what they buy in one single purchase period in the ESPP. So even for those percentage of employees who are flipping their stock, I still feel like this is a great benefit and they're still invested in the company. It's still going to be to their benefit for the stock price to continue to increase. And so I personally do not think that flipping deserves quite the negative press that it gets.
I really agree with you on that, Barb. I think, you know, if we look at compensation in general and equity compensation being a subset of that, I mean, a lot of it is about delivering value to the employee and, you know, engaging them and, you know, making them feel part of the company and wanting to contribute. And there's a lot of positive benefits that come from all of that. And certainly, if our employees are investors, you know, then their interests may be more aligned, you know, with that of, you know, the company and their shareholders. But in terms of the value proposition and the results it gets from, you know, engaging these employees and making them feel that there's tangible value for them in working there, it just seems that there's a lot of positives, regardless of, you know, what they are doing with their shares, whether they're holding them a month or a year or 10 years. So I think there is a lot of negative stigma around flipping shares, and I agree with you that I don't think it's necessarily a negative, particularly if the employee continues to see value in
Right.
purchasing those shares, right? And they're getting that value. You know, if they're getting a great discount and they're seeing this as, hey, this is a really great benefit to me, and I believe in this stock because it's delivering for me, I feel like that it achieves a lot of the results that companies aim for when they put together these plans.
I agree.
So with that, I think we've covered the data and trends that we wanted to hit on around employee stock purchase plans. And Barb, I want to thank you for joining us. As always, it's fantastic to have your perspective.
Oh, I love talking about the survey data anytime.
Yes, and we will continue to be talking about more of the survey data in some of our future episodes. And for those of you who are looking for more information about the survey, note that there's a couple of other resources I want to point you to. So one is that our October 2020 webcast is available to NASPP members on our website. We did take a full kind of deeper dive into the survey highlights. Deloitte also participated in that webcast, so their perspective is there as well. And we, as I mentioned, will continue to cover findings of the survey in future podcast episodes as well. And as for the survey itself, it will be available to qualifying NASPP members later this year. For more information on that, you can visit our website. If you go to our website to the Research Center and look at surveys, you'll be able to get more information on the 2020 survey and how that works. We will continue to talk about this on the podcast, so I would encourage everybody to subscribe. You will get notified about new episodes when you do that. You can subscribe either through your app or via our website, and that way, when a new episode is out, you will be one of the first to know and can have access to all of this great information. So, Barb, thank you again, and I want to thank all of our listeners, and we will see you on the next episode.